Today, we're cutting through all the noise to get you the core takeaways from the financial analysis that really matters. So our mission today really is to just cut right to the chase on this new financial analysis. It's about a NASDAQ-listed crypto fintech company. And we need to get to the bottom of its core thesis, which is, it's a huge question. Is this the most irrational price disconnect on the entire NASDAQ right now?
It's a massive claim. It really is. But the analysis we're looking at makes a very meticulous case for exactly that.
Okay, so who are we talking about?
We are talking about DeFi Technologies. The ticker is DEEC. And the core argument is, well, it's actually pretty simple.
Go on.
Despite a recent, a 17% pop?
Yeah, up to about 88 cents.
Right, 88 cents. The market is basically saying the actual operating business, the profitable part, it's worth, well, almost nothing. Zero.
Yeah, and for you, the listener, this is where it gets really important.
It matters intensely. If this analysis is even close to correct, we are looking at a classic deep value situation, a potential three-bagger opportunity before the broader crypto momentum, fully kicks in for 2026.
So it's the old adage of buying a dollar for 30 cents.
That's exactly what the report is suggesting.
Okay, let's step back a bit. Let's look at the context. Anyone hearing about a stock under $1 is, they're naturally going to ask what went wrong. This is a company that was trading near $5 last year. So what happened? What drove the price down this far and created this huge valuation gap?
Yeah, and the analysis points to two major shocks. Both of them hit late in 2025, and they created this massive wave of panic selling.
Two shocks. Okay, what was the first one?
First was a significant guidance cut. And you know how Wall Street is? It just instantly reacts to that kind of uncertainty.
And was it a big cut?
It was steep, really steep. The company slashed its revenue projection for the year from, from a hefty $218 million. Down to about $116 million.
So they cut it almost in half.
Almost in half. And when management does that, institutional money doesn't wait around to analyze. It just runs for the exits.
Right. And that uncertainty, that wasn't the only thing hammering the stock. There's also this fear of legal trouble, which can just paralyze retail investors.
Absolutely. That's the second major factor, the existence of a class action lawsuit. And it's not just a threat. There's a really crucial deadline coming up on January 30, 2026.
And I'm guessing that lawsuit is tied to the guidance cut.
Directly. The report suggests the suit is alleging the company misled investors about, the stability of those earlier revenue numbers. So you have this combination of missed numbers and this looming legal risk, and that just created this powerful psychological storm.
A perfect storm.
Exactly. This is what the analysis calls weak hands selling. It's investors, usually retail or maybe less experienced, who just panic over the litigation fears. They're forced to sell at these depressed prices, really regardless of the company's underlying financial health.
Okay, so we've got a clear picture of why the stock is so beaten down. Now we have to get into the numbers that supposedly justify this deep value title. Let's break down the actual math here. Why do the analysts believe this sell-off is so wildly overdone, even at the current 88-cent price?
Okay, so we start with the total price tag of the company. At 88 cents a share, the current market capitalization is roughly $286 million.
Right, that's what the market says the whole company is worth today.
That's the sticker price. But here's where the analysis takes a sharp turn. We have to look at the balance sheet. DFT holds approximately $165.7 million in highly liquid assets. And crucially, that isn't just cash. It's a mix of cash and very significant holdings in core digital assets. Specifically, the report names Bitcoin and Solana.
Okay, and those are assets with a real verifiable market value you can sell pretty much instantly.
Instantly. Which brings us to enterprise value. And this is a concept, you simply have to understand if you're analyzing asset-rich companies.
Can you explain that? How does subtracting those liquid assets give us a different picture than just the market cap?
Sure. Think of it like this. Market cap is the total sticker price for the whole car. But enterprise value, or EV, is the true cost of just buying the engine, the part that actually does the work.
Okay.
You calculate it by taking that sticker price, the market cap, and then you immediately subtract the cash and liquid investments the company already has in its glove compartment.
So what's the EV for DFT?
So we run the calculation. $286 million in market cap minus that $165.7 million in liquid assets.
Okay.
That leaves an enterprise value of only about $120 million. That's what the market is saying the actual business operations are worth.
Hang on a second. This is where, it almost sounds too good to be true, and we need to be critical here. You just factored out $165 million, and a big chunk of that is highly volatile crypto like Solana and Bitcoin. If the crypto market crashes next month, that asset cushion shrinks dramatically. how does the report account for that volatility risk in the calculation?
That's a crucial question. It's the necessary challenge, and the analysis hits it head-on with 2 points. First, their liquid asset calculation is, well, it's pretty conservative. It only uses core holdings that are easy to sell.
And the second point.
The second is that the volatility risk is offset by the profitability of the business itself. Because that $120 million operating business, the part that includes their Valor ETPs and their arbitrage activities, is demonstrably profitable.
Yeah.
The report emphasizes they generated roughly $9 million in operating income in Q3 alone.
Okay, that is the essential kicker, isn't it? You're paying $120 million for a business that spits out $9 million in quarterly income, and the purchase price is almost totally backed by liquid assets. But let's define those operations. What exactly are Valor ETPs?
Let's start there. ETPs, or exchange-traded products, this is really their bread and butter. Think of them as financial vehicles. They let institutional investors get exposure to assets like Bitcoin without actually having to deal with digital wallets, custody, all that crypto complexity.
So like a bridge to the traditional finance world.
A perfect bridge. DEFT, through Valor, manages these products. They hold the crypto, they sell shares that track the price, and their revenue comes from charging AUM fees, assets under management fees.
Which is a great business model.
It's a fantastic business model, high margin, sticky, very scalable. If they attract more capital, their fee revenue just grows.
Okay, so the ETPs provide a stable, high-margin revenue stream. What about the arbitrage piece? That sounds a bit more complex.
It is. It's highly specialized trading. Essentially, DeFi Technologies is playing the tiny pricing differences that exist across different crypto exchanges all over the world.
So like Bitcoin might be a fraction of a percent cheaper on one exchange than another for a split second.
For a split second, exactly. Bitcoin might trade for, say, $100 less on exchange A than on exchange B. Their systems see that and execute instantaneous trades, buy cheap on A, sell high on B. They just capture that little spread.
And they do that over and over.
Thousands of times a day. It's not about speculating on where Bitcoin is going long term. It's a strategy to capture small, reliable profits. And that contributes significantly to that $9 million operating income figure.
That context is so important. It's not just $9 million in profit. It's $9 million from two very different scalable high-margin strategies. Okay, let's pivot to the path forward. If the market really is this irrational, what protects the downside for an investor? And what are the real catalysts that could force the market to, finally see the light and close this gap?
Right. Downside protection is built right into that balance sheet we talked about. Yes, the lawsuit is a massive high-profile risk, but that huge cash and liquid asset cushion, it acts as a powerful safety net. The report actually estimates an absolute cash floor for the stock. Even if you factor in potential legal costs, it's somewhere in the range of 50 to 60 cents per share.
So from 88 cents, the realistic downside is limited, which makes the risk-reward look pretty attractive.
Very attractive. And as for catalysts, we're already seeing some short-term signals. That recent 17% bounce, it was off a key support level around 73 cents. That suggests some smart money is maybe starting to notice this discount and accumulate shares.
And in finance, crossing certain psychological lines creates its own momentum. That $1 barrier has to be a huge deal, right? Especially for institutional money.
It's absolutely critical. The analysis spends time on this. A lot of institutional funds, a lot of indices, they have internal rules. They literally cannot own stocks that trade below $1 for a sustained period.
So being a penny stock is a real technical barrier, not just a stigma.
It's a huge barrier. If DEFT can just break and hold above $1, it instantly removes that selling pressure. And it opens the door to a much, much wider pool of institutional buyers. But the truly massive catalyst, the really big one, is long-term, and it's macro-driven. DEFT is fundamentally set up as a leveraged play on the entire crypto asset class.
Meaning if the whole crypto market goes up, they do even better.
Exactly. And the report anticipates the crypto bull market is far from over. It expects momentum to really ramp up as we move into 2026.
So how does a Bitcoin rally actually boost DEFT's valuation beyond just their operating income?
It's a double whammy. First, because they own the assets. As the price of Bitcoin Solana goes up, that 165.7 million liquid asset figure on their balance sheet, it grows proportionally. Their book value literally increases.
And the second part?
The second is their ETP business. As asset prices rise, the value of the assets they manage in the Valor ETPs also rises. That automatically increases their AUM, which means they collect more fees.
So they get a direct benefit from holding the asset and an indirect benefit from managing a bigger pile of it. Double leverage.
That's the term. Double leverage.
That really pulls the whole analyst consensus together. You have the asset floor for protection, the psychological boost of breaking $1, and this huge macro tailwind from the 2026 crypto cycle. So What's the target? What's the price, the analysis says, corrects this imbalance?
The target identified in the source material is $2.64 per share.
Wow. From 88 cents. That's a potential threefold return.
It is. The overall verdict in the report is a strong speculative buy at these levels. And they're clear, this is a high-risk play because of the lawsuit, but the sheer scale of the valuation disconnect is it's too wide for a value investor to ignore.
So wrapping this up, what does this deep dive mean for you, the learner? I mean, regardless of whether you ever even think about the specific stock, this case study on DeFi technologies, it teaches a really vital lesson in financial analysis. And that lesson is never, ever rely solely on market cap. It just shows the critical importance of doing that enterprise value calculation, especially with companies in these asset-heavy volatile sectors like crypto. If the core business, making millions in profit, is priced near zero after you subtract liquid assets, well, you found a potential imbalance that deserves a much deeper look.
And that raises a really fascinating final question for you to think about. We established the enterprise value based on liquid assets, right? But how should a sophisticated investor properly weigh the value and stability of, say, traditional cash against the value of volatile, high-growth digital assets like Bitcoin and Solana? I mean, how do you do that when you're evaluating the true risk profile of a public fintech company? Does a high potential for appreciation in those digital assets, does it mitigate the volatility risk enough to justify an aggressive deep value thesis like this one? It really changes the whole calculus, doesn't it?